Well, it's September 1st, and welcome to the special Risk Shadow podcast. I'm your host and writer, Lawrence Marvin. And this podcast is kind of an adjunct to the article that we just released today relating to the coming real crash and what's been happening in both the stock market, the precious metals market, and the currency markets. So let's go ahead and get started. You'll notice when I wrote the article that's in the Examiner this week, I made great reference to a guy that we have a lot of respect for, but sometimes he's a little slow to come to the game, and that is Peter Schiff at Euro Pacific Capital. Peter's been popping up lately talking about the fact that the U.S. is going to return to the gold standard, which we've been telling everybody has actually already happened. It's just the fact that nobody wants to acknowledge the fact that they're on the gold standard right now. Proof of that is to look at the dramatic rise of gold value as the dollar declines. The other thing that was really interesting is the fact that Peter, who is the chief executive officer at Euro Pacific Capital, has been talking about something which is a phrase that we coined probably over 2 years ago, and that's the concept related to the phony recovery. Nobody wants to deal with this. The elite media in New York is busy trying to put a propaganda move on the public. There has been no recovery from the recession. The quantitative easing by the federal government is basically what's setting the stage for this even more draconian and disastrous collapse in the financial markets and destroying the currency as well. Unemployment and the unemployment numbers are a joke. The GPD data is fake. Everything out here is basically nothing more than smoke and mirrors to try and design to put a spin on things to make people think that life is fine. If we take a look at the amount of actual real unemployment that's been created and also goes unreported now because these people follow up the unemployment rolls, we're really looking at the United States right now, realistically, an honest countrywide average of probably close to 25 to 30% of the public is actually unemployed. And if we look at the employable public who's out of a job, meaning people who can actually work between the ages of, let's say, 18 and 45, you're going to be looking at actually a percentage that's probably closer to about 40%. So the thing is the fact that Peter, like us, believes that basically all the government wants to do is keep growing deficits. We've got a currency crisis coming. We've got a sovereign debt crisis coming. U.S. Treasury bond market is very close to reaching a point where when it collapses, it will definitely take the stock market down even a more horrific downward decline, which will be something that nobody in this generation or even the last generation has probably seen. And the other thing is the fact that it's like this is the reason why a lot of states currently in the United States, like the state of Utah, are putting their own gold and silver coins, and many states are moving in that direction. So the thing to remember is the fact that it's like we have to go back a long, long time ago, all the way back to Richard Nixon when he took the United States off the gold standard and put us on this basically what is nothing more than paper money mentality that's been going along. So if we take a look at this, the thing that most people don't want to understand is that all currency, regardless of whether they want to realize it or not, has to be based on some physical commodity that's basically limited in size. You cannot just have electronic currency units that work well to do anything. And so Peter's been coming out this week talking about how people need to deal with things. The government needs to deal with things. The public needs to be ready for the fact that this is a collapse. It's coming. It's happening. It's in the process. The stock market has been goosed repeatedly over and over and over by these negative moves by the Fed to try and make things look like they're doing something. The reality is that quantitative easing is not doing anything to help the public, and it's not going to help unemployment. And all that's happening is the fact that they're giving the big banks a free ride. They're keeping the big banks propped up, and the big banks are only loaning themselves money, which is we've written some articles about also as well. So the deal here is that Peter's comments are starting to pop up in a number of major foreign publications, not to mention the fact that our friend Mr. Rabini has been out talking for the last 3 years, but more intensively over the last 6 months, talking about the fact that the United States and the global economy is headed towards what he calls a perfect storm. And a perfect storm is not good news, it's bad news. The joke here is the fact that basically if you look at the White House and Wall Street, they're working hand in hand using the elite media, people like CNBC, the people in the internet media like Yahoo, Bloomberg, and these other people to try and paint this artificially phony picture of the fact that life is wonderful. Yeah, just have to have a good attitude and things won't seem so bad, so to speak. So no matter who wins this election, the bottom line is the public loses because of the damage that's been done by our basically communist, Marxist, socialist president and his administration and a majority of Congress, which has been controlled by the Democratic Party, these people basically have set us up for a disaster. I mean, the car is already driven off the cliff. The bottom line is we're falling towards the bottom of the canyon, but just nobody wants to talk about it. So let's focus on what you can do that should give you the ability to maybe insulate yourself against some of these very, very draconian problems that are coming our way. The one thing to understand is the fact that basically the dollar is going to go into a full-blown collapse. The stock market is going into a full-blown collapse on purely technical levels. There are one or two stocks which you can basically look at as being able to survive what's coming up. The reason we've been pushing Apple in the direction of so many people is not just because the company's fantastic or it has great earnings or it's doing all these things, but the other thing is the fact that it's redefining its industry. And probably within a very few months, what you're going to see is the fact that Apple stock is going to split. It just recently paid its first dividend ever in history. It'll probably split and be added to the Dow Jones Industrial Average to try and make the Dow Jones Industrial Average look better, because the majority of the Dow Jones Industrial Average is basically tied to IBM's value. And Apple is one of the few companies out there in the industrial world that looks good. There are a few others. But right now, the thing is the fact that mining stocks are look good, and the fact that raw metals look even better. The other thing is the other thing that we created and defined for the public years and years and years ago, predating the election of the current administration, is the concept of the currency wars. And the basic underlying philosophy of the currency wars is the fact that the EU and the fundamental model of the EU is failing, will fail, cannot avoid failing. So what's happening is the fact that while they're making all these crazy moves to try and pretend that they're doing something, the reality is they can't avoid what's actually happening. And so, as an example, this week it was brought out in one of the European papers that if the Greek government was to somehow leave the EU, that would slice 10% off GDP for Germany. Well, that's the very least of the problems that they have. The other thing is the fact that the Europeans are busy trying to sell their souls to the Chinese and Asian economy and South America as if they're going to somehow bypass the U.S. consumer and the U.S. involvement in the world economy at large. We just wrote an article this week about the fact that Japan is completely out of cash. They're trying to avoid a major problem, but in the end, Japan is going to default on its debt. Japan is going in the crapper, as they say right now. And so there are a lot of issues related to what else is going on in Asia. They're not quite as good as they appear. The other thing to remember is the fact that precious metal, gold, silver, platinum, palladium, and even copper, these are items that have a tangible long-term value. They are not going to go down as we go into this hyperinflationary environment which the world is moving into. Gold and silver, platinum and palladium in particular, are especially good things to hold on to. You can own them on a physical level. You do not have to keep them in the United States. You can own them outside of the United States, because I believe that at some point in time the U.S. government is going to do what FDR did in the Depression. They're going to try and seize all precious metals. People forget that the great liberal patron saint, Franklin Delano Roosevelt, in the middle of the Depression, basically came through and stole the wealth of people who had precious metals and gave them nothing back in return. So what we have to look at is the fact that that will probably happen again. It will be basically both sides of Congress standing around talking about how they've got to do this. I also think that what will happen is the U.S. government will nationalize a majority of the mining industries that have any gold reserves in the United States. If we take a look at what matters here, which is a historical progression and historical fact, and not the spin that comes out of Wall Street, and like I said, and the extreme liberal business media, which, believe it or not, is people like the Wall Street Journal, Barron's, CNBC, people like Kramer. We look at the people in particular, the group of fools behind Yahoo Finance. These people, I mean, it's like they just blow in whichever direction they feel like they can get ratings on some day of the week. These people historically are always on the wrong side of the market. The other thing, the fact that these people are never going to tell anyone to book a profit. They're never going to tell anyone to sell stocks. So what we have to look at is the fact that these people didn't tell you to get out in 2007. They didn't tell you to get out in 2000. They didn't tell you to get out in 1987. They didn't tell you ahead of time about the financial crisis or the meltdown or anything else that was coming. These people are always after the fact, and their great excuse is that no one could have known. They're just as big a victim as you are, and they feel so sad about it, but it doesn't mean that you shouldn't be buying more stock now. I've written several articles about the fact that long-term the S&P 500 is not anywhere close to finishing its generational decline. We are in the greatest generational bear market in the history of America, and it's basically because of the fact that the American economy has basically been destroyed by Congress and the Federal Reserve. We have had 4 Democratic presidents. I do not count George Bush or his father as being Republican presidents, by the way, because they basically had a liberal financial agenda, which has basically been destroying the dollar. They helped destroy the home market and the home lending market. The federal government does not want to stand behind and protect those that have been basically run over by fraud in the bank lending home loan department, even though they're prosecuting the owner of Countrywide for saying publicly that they knew they were originating loans to people who could not pay them back. Bank of America is virtually doing little or nothing in relation to compliance with a loan modification program that was out there, that they were a great proponent of building that deal, which basically gave them pretty much a parking fine for profiteering off of the countrywide crimes that were committed in the home loan lending industry. So let's focus on what you can do, things that you can own that will be safe, that you'll have the ability to own. And like we said before, these are items that if you own them, you'll be able to convert them into whatever currency that you want. The next step is let's go ahead and before we move actually into talking about precious metals on a full-blown basis, let's stop and talk about the currency wars. When we talk about alternative currencies and the currencies wars, the currency war was based on the concept of the fact that the next world war would not be fought with guns and troops. It would actually be fought by taking and bashing or owning the currency of an opposing country and driving that country's currency in the ground or overinflating that currency to the point where it blows up and dies. And that's basically what's been happening for a period of about 10 to 20 years. We can go back all the way into the mid 80s. At one time, believe it or not, the dollar yen was almost at 250. And then the bottom line is mysteriously all of a sudden the yen got very, very strong. The dollar got very, very weak. And that's because the Federal Reserve and Congress and everybody else decided if we had a soft dollar, why it would make everything so much better for us. These are the same people that see inflation as the only way to bail the world out. And this idea of quantitating easing is really inflation. There's so much growth in the money supply, and it's not going anywhere, and it's just sloshing around. Keeping interest rates artificially low is terrible. But one of the things that we need to do right now is we need to raise interest rates, which, by the way, would also create more income on bonds. It would create more income for people who are holding other types of instruments that are tied to interest rates. So the reality here is the fact that the U.S. government is trying to keep interest rates artificially low, so they think that they can possibly somehow or another dodge the bullet of paying back national debt, which is not going to happen. The other thing is to look at the fact that the proof that the dollar is dying is look at the proof of the dollar and how it trades related to other currencies. The dollar is on a long-term negative slide against most of the major currencies and even against the euro dollar, even though the euro dollar is going to be collapsing here relatively soon. The problem is the fact that it's not collapsing fast enough for people to take it seriously. But as an alternative, we have been explaining to people that as long as 2 years ago, 3 years ago, you could get involved, particularly 2 years ago, you could get involved the Australian dollar, which was about 63 cents to the US dollar at the time. Now the Australian dollar is past parity. It got as high as 110 to the dollar. We see the Australian dollar long term as moving dramatically higher. We think the Canadian dollar can move dramatically higher. There are a couple of other currencies that look particularly good, but these two countries, as an example, have a reasonably decent depth, but they won't be able to handle the demand for their currency when people start to panic. As if we go back only about a little over a year ago approximately, you could invest in a 1-year Australian Treasury bill with a yield of over 4%, about 4.5%, and you still got a currency valuation on it. If you look at owning the Australian dollar over the last year, you got basically about a 4% yield. The valuation of the currency went up, and you're looking at a total yield of about 17%. You can still get, well over the high 2s right now for Australian dollar in a 1-year Treasury bill. Canadian dollar has done extremely well. It's a good place to put money, but you have to get the money out of the country and put it into that currency. Those are some alternative options. But when you're looking at larger amounts of things and you're looking at things where you're going to put more money, then when you start looking at precious metals, the important thing to remember is if you buy precious metals, you do not want to store them in this country. You have the ability to store them in another country with relatively little effort at all. In fact, you can drive right over the border and go to Canada and buy precious metals and store them in any one of a number of very good Canadian banks. You do not want to store them with an American bank. So that's something that also you want to keep in mind. So long term, what happens is the fact that the sterling is under pressure, the euro dollar is under pressure, the yen is under pressure, and you have currencies like the yuan, like the Chinese, who are basically wanting to have the strongest currency in the world. That just makes their day. That's what they're looking for. The Australian dollar basically gets to float up against these other currencies, but the euro, the sterling, and the yen are going to be in a situation where as the economic problems continue to compound, particularly with the euro and the Japanese, they both have this highly socialist background. They have an inordinate amount of debt, which they can't cover. We're to explain to people that it won't be long before the euro dollar is at parity with the U.S. dollar, and a very good possibility that sterling will come back to parity with the dollar. It's hard for people to remember this, but if you go back to the 83 to 85 period, I think it was around December of 83 or December of 84, pound sterling reached a point of parity with U.S. dollar just in front of Christmas that one year. And I remember it very well because of the fact that I was watching it happen in the futures market. So you need to look at these currencies, and you need to understand that U.S. sovereign debt and the U.S. currency is no longer safe for you to hold the majority of your investments in. And if you hold stocks, it's even worse, because the thing you have to remember about stocks is you have a paper on profit, but you go broke in cash with interest. So if you do not book the profit that you have on your stocks and put the money in the bank, you have no profit. It is the proverbial fool's paradise. And that's why you have to be so careful. The other thing is you don't buy anything on margin. You pay for your stocks completely in cash. You can go out and write call options against your stocks to try and create a hedge, which is very easily possible, but most people are too lazy to do that. Mutual funds are facing the same problems, and most mutual fund managers are in denial as well. And denial basically doesn't pay the bills. So let's go ahead and step forward, and we'll talk specifically about precious metals. Everybody knows that I've written numerous articles, and I've had numerous podcasts, and at the Risk Shadow website, which we have run for some time, the bottom line is the fact that we have been a big proponent of the fact that the proof of inflation is built into the price of gold and other precious metals. And we have watched the people at Squawk Box, and we've watched the people at CNBC. We've watched all the fools at Yahoo's finance group, and especially the Market Watch group, tell us over and over again how precious metals could never go higher. They were overvalued. The precious metals market was crashing and collapsing. Mysteriously, guess what? They were wrong about all these things. People like Kramer, who've missed the entire gold market to this point, still don't know how to deal with it, because the bottom line is that market is anti-equities. It's anti-debt instruments. It's hard physical ownership. And when you own gold and you own silver, you can convert it into any currency you want. But let's get back and talk about some purely technical things that relate to this metals market, and we'll talk about gold in particular. If we take a look at gold and its price action over the last several years, and we only go back to even just 2006, if you take a look at the December closing price in the futures market on gold in December 2006, it was $635. In 2007, it was $834. In 2008, it went to a high in February of 1014, dipped back down to 681, which we put a huge buy recommendation out in October of that year, and it came up and closed at 883, which is above the 2007 closing level, and it was a yearly reversal. We had a consolidation pattern in 2009 that was very similar, and in 2009 we closed almost damn near on the high, which was 1226 in December of 2009. In early 2010, the market corrected back, created a consolidation pattern. It retested the $1,000 price level, and then turned around and closed on the high of the year, basically at 1431 in the month of December 2010. When the market opened in 2011, it turned around and traded back down to the low of the year at 1307. And then it traded back up, and it closed in December at 1565 after it made a high of 1911 in September. Now, the whole process while this is happening, all your friends in the Wall Street media all your friends in the liberal media, particularly on the TV shows, even guys like Fox, and the rest of these clowns are all telling you how this is it, the precious metals market is over, it's dead, it can't possibly go higher, it's overvalued, there's no inflation. The proof of inflation is watching gold, because as gold goes higher, the dollar trades down, down, down. The other thing is the fact if it weren't for inflation and some other things that are happening, the stock market wouldn't be basically artificially trading on what is a grossly overvalued level at this point in time. So what starts to happen now is we look at the fact that there is a disconnect that's in the process of happening. As the market has been manipulated, meaning the stock market has been manipulated higher by Fed action with artificial easing and artificial data and a bunch of other crap that's going on, what's happening is it's setting up for a break point. When that break point comes, not only do stocks go down, not only U.S. Treasuries go down, but the dollar continues to spiral grossly out of control. There will be a default by the U.S. government on its debt. The deal is, it doesn't matter when. It does matter when, but the reality is it's happening, and it's the moment of that happening is moving sooner and sooner and sooner in our direction. So if we take a look at the 2012 high in gold, we're looking at 1747 in January. If we turn around and look at where we closed in August, the bottom line is that the close in August breaks what is a declining tops scenario that was created. And so when we closed in August, basically what we've done is we have been able to break through that declining tops lines, and that gives us the ability to break out and retest the high of this year, which was 1785, which occurred in February, the week of February 24th, 2012. The 1119 high was basically the weekly high for gold in 2011 if you're not looking at the spot market. So the point here is the fact that the period of consolidation between the last high and where we are today, when we broke through the declining tops at the end of August, comes into being almost exactly 1 year. That was a range of $400, which created an enormous opportunity to buy gold below 1650, and you could buy it all the way down to 1500 with total safety. And a lot of people were able to buy it between 1525 and 1550. The thing also is the fact that this declining top scenario and the technical formation that's in gold futures right now gives us the ability to have a near-term breakout of another $265 above the current 2012 high, which would take us up to the 1790. We'll go above that, so you'd be looking at 2055. If you go through 2055, that breaks the previous historical high of 2011 at 1911. That opens up another window of acceleration, which allows us to have a run for another $385 to $450 above and beyond, even possibly before year end, if we can get through the 2055 level. So the target of 2297 to 2375 is a very good target for gold in the near term. At that point, we would look at the possibility of another correction, maybe some consolidation. But the deal is, if that correction doesn't last long, then what's going to happen is it's going to stage an explosive move, and then it's off to the races, and it's an acceleration signal to even dramatically higher levels. Silver, which is even in a more bullish position than gold, has, percentage-wise, more growth potential than gold does, because there's a historical relationship between gold and silver. And normally, gold is 10 times the value of silver. So that means that silver is lagging behind gold dramatically. That means if you have gold, let's say at $2,000 an ounce, that means silver is going to 200. Most people can't cope with that. But when you start to see the stampede and the rush in the direction of the metals market, this is a constant source of buying. You've got the Indians buying massively. You've got the Chinese buying massively. Last year they were buying 50, 60 tons at a crack from the World Bank when they could get a hold of it. And silver is basically always been in a lead-lag relationship. So it lags behind, and then it snaps forward, and it runs ahead of gold, and it becomes a precursor to how gold is going to break out. But if we look at the April high in week of the 29th in 2011, we saw a high in the futures market of 49.52. The declining top scenario with the silver market is very similar to the gold market, except in the silver market it's more bullish because the declining top scenario is much steeper, it's much easier to break through. And so if we look at 49.52, we have one high. The second high was 44.14. The recent high was 37.48. So again, once again, The monthly close in silver has broken above this declining tops line. If we look at the December close for silver in 2006, it was 1429. 2007, it was 1649. 2008, it was the only time it ever had a close below the previous yearly December close at 1127, but it set up the correction reversal that created the 2009 rally, which allowed the 2009 rally to close at 1682, of course, which was above the 2007 high. And that rally formation created the ability for the 2010 close at 3091. The thing that people can't deal with here is the fact that all of the spin from the talking heads, and these are people sitting in front of TV cameras who actually really don't know anything, they don't do anything, they don't have a trading record, they don't have a trading history. They themselves, 99 times out of 100, are there in front of the camera because they're no damn good at doing any investment or any investment information. If we look at 2011, we closed at 2787, and we had a low of basically what was 2011 and a high of 4074. The low we rebounded off the low, which was 2638, which became a support window between 26 and 27. So in 2012, so far, what we've had is we've had a reaffirmation of the support between 26 and 27. We've had a new high this year of 3748, which is not an all-time high, but the bottom line is it's a move high, and it's a cycle high. Now what we have is the August close at 3137, and the point is the fact that what this is doing is it's created and opened the door to allow us to have a retest of the $50 level, which is, of course, is setting the stage for a major explosion to the upside for silver, which is going to be basically had the support and demand created by the rest of the precious metals market and gold in particular. So we have hyperinflation that's coming our way, and basically a lot of people don't want to talk about this, but according to my original work from the 1980 valuation for gold, we could be looking at what would be a similar price today of about $7,500 an ounce for gold. And the thing is, if you look at the fact that we're moving into this high inflation environment, even if we had a modest level of inflation, like 25% a year, the deal is it would make it very easy for gold to explode. And of course, that kind of inflationary environment is going to be damning to stocks. It's going to be damning to bonds, because the bottom line is the fact that those yield levels are going to have to come up dramatically. For yields to come up, the cash prices on equities and bonds has to go down dramatically, and that is what's going to happen. And the thing here is sterling looks like it could very easily be an unwilling victim to the fact that all the liberal philosophy and the liberal mentality in the UK is moving in the direction of saying, oh, we'll do quantitative easing. Well, quantitative easing only creates a liquidity trap, and that liquidity trap doesn't do anything to build jobs. It also creates a higher tax environment. You've already got the UK standing around saying rich people are making way too much money. We just need to tax the hell out of them because that would solve all our problems. Well, guess what? We already know that that's not true. And I come back to this, the fact that before we got to 2008, before Obama was elected, I had already written these major forecasts on the fact that the euro dollar, the sterling, and the US dollar were going to come to parity. Not because the dollar was going up in value, but because these currencies were failing, and when they did fail, they would come back in the direction of parity to the US dollar. So what happens is whoever has the weakest currency, quote unquote, supposedly wins. Well, the deal is, what people don't understand is they're already on the gold standard. Peter Schiff says we're going to the gold standard. No, we're already on the gold standard. Gold is already proving that it is the thing that determines the value of these other currencies. That's why gold goes up, because the value of the dollar that's buying it goes down. People don't understand that. They don't like that. They hate that thought. It ruins them. It makes the liberal mentality completely crazy, but the liberal mentality is based on the fact that they want to just print artificial money. Guess what? That never works. It's a failing strategy. It's always failed. And if you look at inflation as a way to solve your currency problem, talk to the Germans, because they are the #1 country that has failed on their currency 3 times in the last 100 years, and it's all based on the fact that they were in a hyperinflation scenario. So I look at basically the Canadian dollar, the Aussie dollar, and the Swiss franc as currencies that are going to go to an overvaluation point, because people are going to be running to those currencies to get out of the currencies that they have that they don't like, that are dying. Precious metals are just pounding away on these currencies right now. They're giving them a lot of pain. And so the bottom line is China is publicly out in the open buying publicly large equity stakes in major gold mining operations around the world. And it's right out there in public domain. They talk about it. They're saying exactly what they're doing. And the reason they're doing it is they're trying to buy gold reserves so they can shovel them back in the direction of themselves. One of the other precious metals that we really want to talk about that has huge upside also is platinum. And platinum's 2008 high created a supersized consolidation pattern that was more exacerbated than gold or silver, and it happened earlier. But it's creating a pattern that will allow for some very explosive upside in terms of platinum's high value targets in the near future, which are going to be tied to inflation. And you're going to have hyperinflation because of the fact that you can have both a move down and a move up in terms of opposite values of assets. You can actually have, quote unquote, a worldwide depression, and yet at the same time, gold and precious metals are going to be king. Commodities are going to be king. And when this happens, it means the price of all food is going to go up. It means the price of all energy is going to go up. People don't want to cope with the fact that basically, like I said, the U.S. economy is a car that was driven off the cliff in 2008 by the Democrats and the Obama administration. And basically, we just haven't hit the bottom. So the thing of it is, whoever wins this election in the long run loses unless they have control of the presidency and all the houses of Congress, and they throw Ben Bernanke out and his inflationary policies related to the Federal Reserve. So I'm looking at the fact that platinum could easily go to as high as $8,500 over the next 4 to 5 years. And if you'd have talked to anybody in 2003, nobody then would have possibly been able to deal with the fact that within 60 months of the 2003 low, that platinum will be trading at almost 4 times its physical value. The low of platinum in 2003, by the way, was just around $590. So these people can't focus on the fact that everything is happening outside their frame of reference. It's not politically convenient. It's not what the talking heads or the media in New York want to talk to you about. And so they're going to have to come up with some kind of boogeyman or some kind of something else along the way to come up with some excuse why nobody knew. There was nothing that could be done about it. And it wasn't the White House's fault. It wasn't Congress's fault. It wasn't the Federal Reserve's fault. The bottom line is these people are responsible for destroying the economy, the currency, and everything else that's tied with it. And if you want to point the finger at somebody, point the finger at anybody who's been a long-term incumbent in Congress, because these are the people that have basically put the screws to you. So if we look at one other commodity, and that's copper, copper is basically a sleeping giant. It's got the ability to make very strong long-term upward moves. It's not going to have the same volatility as precious metals, but the bottom line is you could be seeing 750, then 875, then 975 over the next 4 years in copper, but there's going to be a lot of volatility. So if we look at all these major currencies that are going to go into this meltdown mode because of inflation and because of other problems that are tied to sovereign debt, lack of earnings, high unemployment, you're going to see explosive valuations on metals that will define or redefine historical highs in volatility. U.S. Treasury yields, even on one-year Treasury bills, as the yields on Treasury bills explode because of the fact that nobody wants to own U.S. Treasury bills, you're going to see yields that will exceed the 1987 levels. And by the way, one-year Treasury bills in 1987 got as high as 14%. As the great Treasury bond market crash develops, you're going to be looking at prices in U.S. Treasury futures. Once they drop below 104, which is a milestone near-term low, it will signal an even longer and greater decline that takes longer time, and you'll see yields on Treasuries that will probably haven't been seen in probably 20 to 30 years. You're beginning looking at double-digit yields in U.S. Treasuries because people don't want to own the debt. And then you're going to be faced with the fact that the next thing that happens is default on the debt. And that's why you have to get out of U.S. Treasury bonds, you have to get out of U.S. stocks, and you have to pick your stocks very, very carefully. So I appreciate your time, and once again, this has been your friend The Shadow. And remember, you only have 2 choices, trade or die.